cash outflow is all the cash we expended that involved cash. Now, for operating activities, the cash we received from customers will form part of this. The cash we paid in terms of salaries, rent, etc. will form part of it. But when we are preparing the statement of cash flow, what we do is this. Anything that we receive in, we know it's ours. So we don't cover in jacket. We call it jacket. By the time you say 50, this is, you are jacketing it. So an accountant, it means that you are deducting that value. So the cash we receive from customer, they will be unjacked. While the ones we paid, because it's actually reducing the amount of cash we have with us, so you put in jackets. The interest you receive, this interest is usually in two ways. Now, there's something we call significant influence. And what that means is that when you have a company where you have significant influence, that means that you have close to 20 and above, you have more than 20% interest in that company. Okay? These interests will form part of your operating activities. Now, for investing activities, these are the activities in terms of purchase of equipment that we pay cash for. Purchase of assets. Extension of building extension. Interest received where you do not have significant influence. That means you have less than 20% interest in that company. So it applies here. Now, for the financing activities, this is where you have.
On this extension of building, the first spending 200,000, you mentioned earlier that you have to amortize over a period. Is it that bulk amount you are going to recognize on the extension of building?
The actual amount you paid in terms of cash. So here in your financing activities, you have what we call dividend paid to shareholders. For example, okay, let me just tell you what this financing activity means. It means that, look, as Lily now, we have interest in another company that we have shares in. And the amount at which, for example, they said, okay, for Lily to come and be part of this good news, okay, you need to pay so much in terms of raw cash. You understand? To enjoy such opportunities. The actual amount you paid will fall under financing activity. Because you are actually using your resources to finance the activities of another organization. But for the investing, what you are doing to really move your company to the next level in terms of your equipment, the purchase of equipment and the likes. So at the end of the day, after the addition and subtraction of the operating, the investing, the financing, you must always come at a level where the balances you have in your bank in terms of money or treasury bills must equate what you actually have on ground. So what that means is that if my director picks up our bank statements in all the banks, and I gave him an idea that, okay, for 2011, for example, that the amount that came into Lily, for example, was 1 billion naira. By the time he sums everything up, we must give him this 1 billion. That's the check here. That's why most accountants, it takes them like 3-4 months to prepare the financial statement for 1 year, which they must have been doing every day. Because by the time they come here and they see that it does not tally what they have, they go back again, start checking, start casting. So that's just the beauty of this. Thank you very much. So that's
Questions?
How do these three statements you have described to us,
okay.
where do they meet each other? I know there's a point where profit and loss or probably mix with your balance sheet or your position. And there's a point where your balance sheet meets with your cash flow. Or where, I don't know, there's a link.
Okay, what we are according to what we gave us, he said all the statements, I think the cost changes to something like that, to the financial statement. And he said which statements are, I've forgotten the question.
The question sheet?
It says something changes to something.
I don't know which number.
Question 5.
Question 5.
Which statement summarizes changes to mass?
Now, for the statement of financial statement of comprehensive income. For the statement of comprehensive income, these two feed this. Statement of changes in owner's equity 2 comes here. Because not up until now, I think what we were doing before was that we don't really prepare statement of changes in equity. It's not really pronounced because by the time you go to your statement of financial position, you actually have an idea. But now IFRS has made it has mandated it that you must show it. Now, we want to know the owner's equity at the beginning of the period. We want to know what they have injected into the company during the period. We want to know how much they have taken away from the company during the period. And at the end of the day, whatever they have must give us an idea of what is in the statement of financial position. So this and this meets here. Now, for statement of comprehensive income, your prepayments, like I said, your accruals, your depreciation, okay, these are the only ones. Now, they've found changes here too. Because this will actually, the prepayment, for example, like I told you about rent, you paid 5 million for rent, and then you have resolved maybe 1 million. It changes what you have here. Statement of cash flow. You purchase an asset for 1 billion. It changes the stock of fixed asset you have here, or non-current asset that you have. So these two feed here. So that's why most investors, be it potential too, they look majorly at your statement of financial position. Here, your P&L, whether net profit or loss, still feeds here too. So by the time they study critically your statement of financial position, they understand where the company is coming from. They know what the company has delved into. At least it gives them a picture of what is happening before they can invest.
Okay, thank you very much.
Thank you.
I'm asking a question. I'm not allowed to ask a question.
Yeah.
Okay.
Yeah, of what importance is calling the value as common value and asset and then putting it as something you mentioned about?
Okay, so we have
What importance
now.
is it?
What he does is this.
Yeah.
You see, Oga has mandated me not to go far. In fact, I would have probably introduce what accounting is usually based on. There's something we call historical cost. That is the essence of accounts. What this means is that for you to value an asset, for you to put an asset in your books, you must say, okay, the purchase cost of the item. Now, and other incidental costs. Incidental costs of bringing the asset from where you purchased it to the place of use. Now, let's say, for example, for us to claim capital allowance. What capital allowance means is that for the taxman, rather than give us depreciation, they will not. They say they will give you capital allowance. The law has rates that have been applied on capital allowance for each asset class. Now, what we do in account is, okay, we purchase this fund, for example, and we have said that any assets from 50,000 above should be termed as fixed asset. Then any asset from 49,999 down should be expensed. That means we are big, so having an asset of less than 50,000 naira will not add anything to us. Let's write everything off. It's accepted based on the policy of the company. Now we have said, okay, these assets, we have purchased it. We acquired the services of a laborer to carry the assets, bring it here. We called an electrician to fix. Accounting says all those things you expended, group them together and call it the purchase price of the item. Now, a valuer comes and says, okay, let me see the makeup of the assets. You tell him, okay, the makeup of the asset is 5 billion. Say, okay. He looks at the fair value of the assets. That means the value at which that asset can exchange and between me and the third party. That we can agree and say, okay, this is how much we will sell. He looks at the market value. The market value is, when I get to the market today, how much will this asset cost? He looks at the breakup value. What this means is, oh, if I say I don't want this asset, no, and somebody is coming up to take up this company, how much will this person be willing to pay for the assets? He has an idea. He said, okay, let me look at it. Now, this asset is 5 million, was 5 million when they purchased it. But now, based on the one that I've done analysis on, and I come to a conclusion, oh, the asset is actually 5.5 million. So the essence is, it gives your assets that level of, in fact, we believe that by valuing it at that level, it gives you an idea that, oh, you can still use this asset for more than the period you have initially stipulated. The productive capacity of this asset will still lead, will still carry us for another maybe 2 years, rather than write off the assets when we have said we are going to depreciate it too. So that's the essence. It gives you an idea of the productive aspect of the asset.
What was actually asking is cost of land.
No, land, we shouldn't depreciate land. In fact, it appreciates it.
Yeah, well, what I'm saying is, like land, usually state it as the cost.
Yes.
Is it fair?
No. In fact, land also falls.
They can do revaluation
Of course,
revaluation.
of course.
Of course.
And bring it to market.
Yeah, bring it up to market value.
Yeah, what I'm saying is, what use is it in your financial statement? If you decide
Okay, one of the reasons, like, you borrow against your assets. So you want to borrow, more money.
Yes.
Your balance sheet is saying that your asset is 100 million.
For the past 5 years.
But meanwhile, you have been carrying your head office complex for 5 years now, the same price. But the price has tripled. So revaluation, you bring an estate surveyor to certify the new value.
In fact, if you get a land for Lekki about 10 years ago, for example, the land was 50 million. Let's take for example. Now, to get a land in Lekki, you don't have 180 at time, and it even depends on where. If it's very close to the road, so but you need to revalue to bring it to the current.
The essence of revaluation, it is not all items you can evaluate. You have that For example, if you want to go into merger, you want to go into acquisition, you want to go into partnership, or you want to buy franchise, you want to consolidate. Maybe they're asking that doctors to have, hospital must have certain. You want to consolidate, you want to upgrade your balance sheet, or you want to access credit. It is good. All this revaluation will push your balance sheet forward.
In fact, when it comes to business analysis at times, and the company comes and wants to take over your company, for example, you need to revalue those things. If you don't, you'll be selling at a price that will be less than what current price should be.
I know that there was another method of valuation.
Yeah, because what they are saying right now, what they are valuing,
People use net assets.
your income statement, and you use your net profit, and you use price earning ratio, and
You
stuff
use
like that,
some
and then
strategic financial
cash for cash. Not your assets don't use money. The assets you have are not produced.
They are producing money, we should see them.
Yeah. So the money you have produced for us, that is your value.
Okay, yeah. For me,
There
that
are all kinds of methods. Yeah. So
if you are looking at the market valuation, then you are not looking at assets. The most efficient way of determining the value of the company is the share price. How much people are willing to trade for it. That's the most efficient way. The other ones are subjective. The one that is open.
But now you're not on the stock market.
And you are not on the when you are a private company.
Exactly.
People are not trading on your shares. So you now come up with other methods.
But you still use that same method and just give us a P ratio at what he thinks is acceptable at the market for the kind of business that we do. The highest form of P ratio can ever get.
It's a bit subjective. Like one thing you can do in unquoted companies is you can value all the assets, run the financial ratios, compare it with a quoted company. Compare it with a comparative quoted company.
They're only comparing the ratio of 10.
They have a P ratio of 10.
Uh-huh.
Our P is 10. They look at the market situation right now, look at where Lily is. They feel that Lily is at this level of the market. So they give us the arbitrary figure of P of 10. So with that, they use values. We're having for 12, but they said from what they can see, it's 10.
We use a comparable company that is quoted and they compare the ratios.
I want to mention something regarding to what you said. You can see a company having a loss, and that company is still viable to buy. You go as far down as the liquidity position of that company. You go as far as what is the asset value. That was what happened to a big bank and Platinum Bank. You know, a big bank, they have assets, but they don't have the cash. Platinum Bank had the cash, but they don't have assets because they were limited. So that was what helped their merger. So at times, if you look at the profit position, you want to determine the financial performance of an organization, you will be getting it totally wrong.
We are doing it, we look after this. All these private firms, they don't want to know. In fact, because our profitability the year before was higher than the profitability of the year they chose to value us in the last year's profit. 2 years ago, it was higher than that. But I say, why did you use 2 years ago profits?
No. Who used that?
They are going to use profit of today when they can see the last
one.
Right now, profit.
It's still subjective either ways. You could choose, but everybody wants to be safe. For example, if it's against lending, assessing credit, you want to use the worst case.
The school of thought that that doesn't support that in the case of the banking industry. 6 months back, CBN said these banks are healthy. 6 months now, they said they are dead banks. Basically, if you are looking at that, it should go as far as you looking at the risk asset. What is the exposure of this organization? This asset that you have, is it an asset that can endure? You know, it involves a lot of financial analysis. Because if you're looking at, oh, this company was profitable last year, this year is profitable. Let's say Oceanic Bank, 3-5 years, they have been profitable. And suddenly, Sanusi said, this is not true.
And profits,
and
like I'm sure you know already,
I know.
profits
It's not cash.
It's not cash.
We do that.
It's It's a story. Profit is a story. To the non-financeable, they think profit is cash. Profit is a story. I mean, like when Bolaji was saying, I can imagine there are a lot you need to go into in the policies. One company is saying anything above 2,000 naira is an answer. Another company is saying anything below 50,000 is. So that will all affect the story the two companies will tell at the end of the year.
So also remember the time when you see balance sheets and you see figures, and you see profit and loss and you see some finance, and don't assume that money is there. That money is paper money. It's story money.
The story.
It's not available at all. That's why the cash flow is so important. That one is the cash that comes in and goes out.
The one you can see.
The one they are not giving to you is not your own.
So let's try and answer these questions. Question number 1.
Is it a true or false?
No, ABC. So question number 1, the income statement measures what? A, profitability. B, assets and liability. C, cash. D, all of the above. You raise up your hand, please. You know the answer. Emily.
A.
A. Who is against that answer? The answer is A. A sale on the credit ends up on the income statement as revenue and as what on the balance sheet? A, accounts receivable. B, long-term assets. C, short-term liability. D, operating cash flow. You know it, raise your hand.
If you have marked yourself, when they tell the answer, mark it.
If you have marked it before, check now whether you got it. The self-assessment.
A.
It's account receivable.
Hey, who said A again? Emily is flying. Okay, question number 3. What happens when a company is profitable but collection lags behind payments to vendors? A, the company is okay because profit always becomes cash. B, the company stands a good chance of running out of money. C, the company needs to shift its focus to EBIT. D, the cash flow statement will show a negative bottom line. If you know it, raise your hand.
B. I chose B, yeah.
The answer is B. If you are not collecting receivable as fast as you are paying vendors, you will need more working capital. Question number 4. What is gross? How is gross profit margin calculated? You know it, raise your hand. C. The answer is C. Question number 5. Which statement summarizes changes to parts of the balance sheet? A, income statement. Okay. Which?
I think both of them the income statement and the cash flow statement.
So part of the balance sheet, yes. Which statement summarizes changes to parts of the balance sheet?
Summarizes.
It's the two. It's both of them.
Okay. The answer is D. Both of the above.
The cash becomes the cash. The cash in the cash flow becomes the cash in the balance sheet.
Okay. Question number 6. EBIT is an important measure in companies because what is C?
It again profitability of operation.
We all agree?
Yes.
The answer is C. Operating cash expense includes all of the following except
I think it's C. Expensed.
Operating expenses include all of the following.
Operating is sales, administration, and general expenses. Yeah, because research is like expense.
It's
Design
C.
things. So it costs
Huh?
a good
C.
source. Yeah.
Who agrees, who disagrees?
And you will see. Delivery of raw material. What?
The answer is D. Delivery of raw materials.
Why delivery of raw material? Explain that one.
And don't you have number 7?
Delivery here from the it's part of the cost of goods sold. Yeah.
Cost of sales.
So where will research come in?
Research.
Because you are looking at design of a
Research, it's research and development.
And it's supposed to say research and development.
yeah.
It's research and
It's
All the
capitalized.
expenses incurred in research and
It's
development.
capitalized.
It's
And
capitalized.
it's even good into
Owner's equity, number 8. Owner's equity. Owner's equity in a company increases when the company
Increases profits. Right, you see, increases profits.
C. What is C?
Increases profits.
Increases profit.
There's fixed asset there, right?
Increases debt by paying off the increases assets with debt.
No, you don't have it. Yes, you have.
Accept it.
But not
I
able to-
think I should
When you
accept
add,
it.
you're adding retain any to one other.
If you move more money to reserve.
The answer is C. When the company increases its profits. Number
We don't have a lot of competition now.
owner's equity.
Accounting.
When you increase profit, you see the balance sheet. What do you do? You go there, you add it to.
I thought equity was in terms of share.
And the share, yes, now.
Your retain any is also coming there.
Your retained earnings goes to share in the balance sheet. Number 9. A company has more cash today when A, customers pay their bills sooner. Accounts receivable increases. Profit increases. Retained earnings.
Is A.
Yes, now.
Customer pay their bills
The
sooner.
answer is A. That's when the customer pays now.
Now.
It's better when you pay cash there.
Number 10. Which of the following is not part of working capital?
C.
See.
C.
Property.
You did some good jacking.
I know it's C, so I know.
Oh, you didn't see it?
Yes.
Yeah.
That's why it's vibrating stuff.
The way it's vibrating. It's not vibrating like a laptop. It's taking me by storm.
That's why he was not calling you. That's why you're about
Okay, so this weekend is the only weekend we are free since the class started. No case.
Thank God.
Just go and prepare how to run
Read
your
our
topic.
mind back.
Before you go, I would suggest you meet 10 minutes in your various groups. There's a second conference room on the other side. Group A or B, Group A or 1, the other group there, 2 groups on the other side. You need to discuss now. If you need to meet over the weekend, you have to meet. Then on Tuesday,